All right, we will get started. We still have several people rolling in. Thank you for attending
the meeting.
Our annual payroll and year-end reporting webinar presented by Hawkins Ash CPAs. Hawkins Ash CPAs ranks among the top 200 accounting firms in the nation. With 10 offices in Wisconsin and Minnesota, our 175 employees provide local tax, audit, and accounting solutions to our clients. Learn more about Hawkins Ash CPAs and our services on our website at hawkinsash.cpa. Earlier today, each attendee received an email that included the presentation slide deck along with the sample spreadsheet. I will drop those links into the chat box. If you did not receive that email, you can click those links in the chat box and receive those there. This presentation is recorded, and a video link will be in an email to you early next week, and that will be sent to all attendees. The recording will also be available on our website, hawkinsash.cpa, next week. To ensure a clear broadcast for all attendees, please mute yourself. If you have a question, you may enter that in the chat box feature, and I and Debbie will monitor that to ensure we provide an answer. So with that, I will introduce Debbie Denny. Debbie is an accounting services manager in our Green Bay office. With more than 20 years of experience providing bookkeeping, tax, and accounting services to clients, Debbie is also an advanced certified QuickBooks advisor for both desktop and online. She also has thorough experience with Sage 50 software. So we have a lot of content to cover. So Debbie, please take it away.
Okay, thank you all for joining today. There's probably more people that are going to jump on, so hopefully they'll just get on the broadcast that Corey publishes next week. So can everybody?
We can hear you just fine, Debbie.
Okay. Okay, thanks, Corey. So we will start by looking at the first slide, because it should say year-end reminders for 2021 and changes for 2022. So we're going to not go backwards, we're going to go forwards, and we're going to talk about a lot of things today. Let's see if I can advance. There we go. And again, this is just a little slide telling all about Hawkins Ash and just some of the things that we're, in our different offices, things like that. So things we're going to cover today is the 21-22 changes, some W-2 information, pre-tax benefits, fringe benefits, employer versus independent contractors, the Affordable Care Act, and just miscellaneous stuff. So first we're going to start with the changes coming for 2022. Some of these are actually just a review also of 2021. So the FFCRA, the Family's First Coronavirus Response Act, and the American Response Plan Act, AARPA, they both expired as of 9/30/21. So we're no longer going to be doing those fund calculations for payroll so that are out on COVID leave. The CARES Act also has the employee retention credit associated with it. And a lot of people are taking advantage of that right now. We're going to go through some of the criteria about that later. Then there's a Cobra premium credit. The CARES Act also has an employer tax deferral, and we're going to talk about the payback periods. And same with the employee tax deferrals. Something new for 2021 W-2s is you're allowed to mask the employee Social Security numbers. The white collar salary threshold came about in, they changed the limits, I believe it was last year. Form W-4, e-file requirements, and tax rate changes. So again, here's the FFCRA and AARPA, just the different time periods it covers and the different sick leaves. Again, this is expired as of 9/30. And here's the employee retention credit. If you have not claimed this yet, we can still go back and amend prior returns. So you want to look at your gross receipts on your profit and loss statement, compare 2020 with 2019, and if the gross receipts is less than 80% of the same quarter in 2019, then if you have employees, you should take a look at filing the ERC to get some money back. We've saved thousands of dollars for our clients by doing this. I mean, thousands and thousands. So it's something to look at. If you do have employees, take a look at that, and if you haven't already. The Cobra premium credit, this extended the Cobra election period to 60 days after the employee has provided notice. If you're eligible, the government would have covered 100% of the premiums, and again, this expired as of 9/30, and then the premium was reimbursed to the employer. And again, the employer tax deferral. So if you did, as an employer, hold back your share of the FICA taxes, 50% of it is due, and the other 50% is due on 12/31 of 22. Then the employee tax deferral, that's when employees could withhold, stop taking the FICA, and that payback is by the end of this month. And it's supposed to come out of the employee check, and if the employee has since left, the employer is responsible for that money. And once the employee has paid back that deferral, what you need to do as an employer is file an amended Form W-2 or W-2C for the year of 2020, showing the payback amount. Again, starting 1/1/21, the employers can truncate these Social Security numbers. You can only do it on the employee forms, not the forms that are actually sent to Social Security or the states. And on 1/1/2020, the minimum salary for the white-collar salary threshold increased to $684 a week, which is $35,568 a year. So if you have employees that are managers type employees and they're making this kind of money, you can put them on salary, which means that you don't have to pay overtime. Let's see, the 2021 Form W-4 is new, and you should be using that for all new hires. It is a confusing form, I will tell you that much. And if you just Google IRS W-4, it will give you a link to get there's a spreadsheet type form to fill out online. You're probably going to want to have your tax return there because it's going to ask you all kinds of questions relating to your tax return. So just a couple instances there that it's kind of confusing. The Social Security, right now it's pending IRS final regulations, but right now they want to, in 2022, if you send 100 or more W-2s, they want you to electronically file. And in 2023, if you send 10 or more W-2s, they're going to want you to electronically file. So that's a big thing. So if you've got, if you don't have electronic filing right now available with your software that you're using, that's something you're probably going to want to look at. And here's our fact sheet for 2022. The biggest thing that's different is the Social Security wage limit has gone up from $142,800 to $147,000. Everything else pretty much is the same. The Minnesota wage limit for unemployment, we don't have yet. It hasn't been published. Minimum wages are the same for Wisconsin, but for Minnesota, they change. And in Minnesota, from the cities of Minneapolis and St. Paul, those are based on the number of employees you have, and that rate changes in July, on July 1st. So you're going to want to keep that in mind. Other retirement plan change limits. 401ks, you have up to another $1,000 of additional contributions you can make. The catch-up stayed the same. For simple plans, you've got an extra 500. The catch-up stayed the same. IRA contributions have not changed. HSAs have changed a small amount, and the standard mileage rates have not come out yet. So just a couple things that we will, once we do have that, those amounts, we will have this published on our website. So keep a look at that. Required employment posters. So if you do have employees, there are posters that you are required to put up in a break room or somewhere where the employees are going to be able to see them. I've seen them up in bathrooms before. So just make sure that, you know, if you do have employees, these are things that you have to have posted that your employees are aware of, the different employment practices that are required. Okay, some W-2 information. The due date right now for 2021 W-2s is January 31st, 2022. That is for paper filing and electronic filing. There is a 30-day extension that you can have to submit the Social Security copies to the SSA. It's a Form 8809, and it has to be sent in by 1/31/22. And in that case, you must still provide the W-2s to your employees by 1/31. There is a way that you can request the extension of time to give those to your employees. You've got to fax a letter to the IRS, and this is some information that they're going to require. The W-2 publication does have all of this information in it. If you want to read that, it's kind of boring. So again, this is the Form W-2 for 2021. So when you're doing that W-2 form for your employees, you just want to make sure that your software, or if you don't have software that calculates everything, that you are calculating things correctly by taking for your federal and state wages, your gross wages minus any Section 125 plans and dependent care, it's an FSA type of insurance cafeteria plan. Then you have your net taxable wages for Medicare. Then you subtract off your 401k, and then you have your amount of federal taxable wages. So it's all you deduct your Section 125 cafeteria plans and then deduct any 401k or IRA plans. Social Security, it's pretty much the same thing, except for you don't take the 401k into consideration. So it's just your Section 125 plans, and that's all. And again, in 2021, 142.8 is the amount of Social Security taxable wages. So as the employer, that's the only amount that you have to pay in for the 6.2%. In 2022, again, that changes to 147. So just be aware that after the employee hits that dollar amount, you are not required, they are not required, and you are not required to match the Social Security. Medicare wages has no limit, and then they have an additional tax. So if your employee makes over $200,000 a year, they have an additional Medicare tax of 0.9. So if I look, this is the same calculation on top as the Social Security. Again, we don't take into consideration 401k. So in this instance, $20,000 is going to be taxed at 1.45%, and then the difference, the $4,200, is going to be taxed at 2.35, which is the 1.45 plus the 0.9%. So here are the box 12 codes that go into your W-2. The majority of the ones you're going to see are your Ds for elective deferrals under 401k. That's a very popular one. Ws for employer contributions to an HSA. If you've got a 408 simple plan or There's just a lot of different ones out there. A lot of them have to do with your retirement plans. Code DD, if you are an employer that sponsors health insurance for your employees, you're going to put DD in box 12, and it's only required if you have 250 or more employees. Supplemental wages. These are wages that are different than the ordinary day-to-day wages. They are bonuses, commissions, prizes, awards, severance pay, things like that, that are just your non-normal pays. So for supplemental wages, the withholding can be different. So normally, a lot of people will withhold it at the regular W-4 rates. If you pay them separately, then you should withhold at a flat rate of 22%. And if the employee receives more than $1 million of supplemental wages during the year, you need to withhold at 37% for the federal. Minnesota's a little bit different. If you pay them separately, you're going to withhold 6.25, regardless of what they have on their W-4 for Minnesota. And Wisconsin pretty much follows federal also. You can just let the system or withhold at the normal rates, or you can use a flat percentage. 401k, 403bs, simple IRAs. Again, these are your pre-tax for federal and state only. Your 401k Roths are after-tax contributions. And if you've got employees that are contributing both to a 401k and a 401k Roth, you have to combine those in order to find their max that they're allowed to contribute during the year. And again, the key fact sheets that we looked at back here tells you the maximum that they are allowed to contribute. Make sure that you know if they're adding them together, or if they have both, the adding together of them cannot be more than the max. These are your retirement plans, and this is one thing that the IRS has a lot of issues with, that people check the box when they shouldn't check the box, or people aren't checking the box when they should. So here's some different examples on what your plan might be and the conditions, and if you should or should not check the retirement plan box. And again, here are the box 12 codes. We kind of looked at all the codes before, but these are the ones that are strictly retirement plan based. So when you are doing your W-2s at the end of the year, you want to make sure you're reconciling. And what I mean by reconciling is your W-3 form should match the totals on your 941s that you filed for the year. So if I look at the spreadsheet, which should be in, I believe, the chat, and you might have already received it from Corey, but it is taking my 941 form for each quarter of the year and totaling it up. Any 401k, things like that, you're going to put in your 101. You want to tie that out also. So for Medicare wages, for 5C, line 1, taxable Medicare wages is $29,1543, which when I take this, what this is doing is it's taking my wages from box 2, subtracting out my 401k, and there I've got, or I'm sorry, adding in the 401k. So then my taxable wages here are the $29,1543, which matches my Medicare, and also your UC 101, your state unemployment, that should also match. The only reason the UC 101 wouldn't match is if you have related parties that, you know, are the owner's children under 18, or maybe the owner's wife that aren't contributing to the unemployment. Or sometimes if you can, as the owner of a company, you can elect out of state unemployment, but then when you do that, you have to pay a higher federal unemployment rate. So You want to then enter your W-3 amounts and check the differences. Your differences shouldn't be a lot. If anything, they're going to be caused by rounding. But this is what the IRS is going, or the Social Security Administration is going to do. They're taking, and they're going to talk to the IRS. So you're sending the W-3 to Social Security, your 941s go to the IRS, and then they compare the amounts. So if they are off, you're going to get a letter saying from either the IRS or SSA or both, saying that your numbers are off. Tell us why. Now we're going to talk a little bit about pre-tax benefits. And pre-tax benefits are that. Again, when we looked at the Section 125 cafeteria plans before, when we were calculating federal wages, that's these tax favored plans. So the health savings account, an HSA, if you're, let's see, you get to take a deduction on your 1040 for those contributions if you're not taking them through work. Only qualified medical expenses can be reported as a tax deduction. So if you're using that money for groceries or something like that, that amount that you're taking from the HSA is not going to be tax-free. With your HSA account, your interest and earnings, those are tax-free, and it is your account, so it is portable. You can carry it to whatever employers you're going to next. Qualifications, you've got to be covered under a high deductible health plan. So in 2021, if you're single, that dollar amount is $3,600, the deductible, or $7,200 for family. And in 2022, it goes up $3,650 for single and $7,300 for family. And there's an additional contribution of $1,000 if you're 55 or older. So as long as you have the maximums for your high deductible health plan, you can put money into an HSA. And that money can stay in that HSA as long as you want. Some people put it in there and just leave it there, and then once they get older, they start taking it out when their health is getting a little bit worse. And again, you cannot use this if you are enrolled in Medicare, because that's like your health insurance, or if you're claimed as a dependent on someone else's tax return, you cannot have an HSA. Then there is a medical savings account. Again, this can be claimed as a deduction on your 1040. Interest and earnings are tax-free. You can carry it around to job. The employee of a smaller employer, you have to be 50 or fewer employees during the year. That employee can have the MSA. A self-employed person or a self-only or family, high deductible again. And you cannot have health or medical coverage. There's an annual limit of 75% of the annual deductible of the high deductible health plan, 65% for self-only plan. So you can make contributions, the employee and employer, but the employer and employee cannot make contributions in the same year. So it's a little different that way. Then there's a HRA, Health Reimbursement Arrangement. This is funded only by the employer. So as an employee, you don't put a cent into it. Employers will do this if they can't afford insurance for their employees, but they still want to be nice and give the employees something that they can use for their medical expenses. The employee is reimbursed tax-free for those qualified medical expenses. There's no limit on the amount that your employer can contribute. And again, it can be carried over to the following year. A qualified small employer HRA is going to have fewer than 50 full-time employees. And again, there's limits for 2021 and 2020, 2022, and different limits for family or for individual coverage. Then there's the FSA. This is one that most people are very familiar with. Medical care reimbursement, dependent care reimbursement, and adoption assistance. So the HSA, it's a pre-tax deduction for the employee. The employer can also contribute to the plan, to your plan. There's a maximum contribution limit of $2,850 a year. So the employee gets reimbursed for their medical expenses, and the employer, if they if the employer contributes, they get a deduction and expense on their tax return. It's an employer established plan, so a self-employed person is not eligible. The employer can match up to $500, and then starting at $501, the employer can only match dollar for dollar. So they can put $500 into your plan immediately, and then once you have over $500 in that plan, once you hit $501, if you're still putting money in, they can match dollar for dollar. The employer can utilize a carryover or grace period. So this means that normally your FSAs are use it or lose it, but there is a carryover option that the employer can elect, saying that the employee may carry over up to $550 in 2021, and that goes up to $570 in 2022 to the following plan year, or they give you a grace period option of 2.5 months after the end of the plan year to incur those expenses. Again, it's one or the other. So your employer is the one that is going to dictate that. And there is a special COVID relief option that gives the employers the option to allow employees to carry over their unspent 2021 balances into 2022. And again, this is only during the COVID years. Once the government decides, nope, COVID's over, if that ever happens. So this is just a special option during COVID. But again, you've got the carryover option or the grace period option. Dependent care FSA, again, it's pre-taxed, pay for daycare, preschool, summer camps, and non-employer sponsored before and after school programs. The expenses for dependent care are related to kids that are 13 or under, or if you have a special needs individual. The ARPA raised this pre-tax contribution to $10,500 for 2021 only. So 2022, the pre-tax limit is going to go back down to $5,000. And you cannot discriminate. So you can't say, okay, only to my managers, I'm going to let them have a dependent care FSA. For all my workers, they can't get it. That is discrimination, and then that becomes taxable for everybody. And if you've got employees that want to adopt, there's also the adoption assistance. It's a pre-tax used to pay for necessary and reasonable expenses relating to adopting a child. This gets phased out based on your income. It cannot be used to adopt your spouse's child. So if you're in a relationship that your spouse has a child from a prior relationship, you cannot use this plan to adopt that child. Again, the phase outs for 2021 is $216,000. For 2022, it's $223,000. And that means if you are earning $216,660 in 2021, the maximum of $14,400 starts phasing out. So if you make $250,000 for the year, you might not have any assistance that you're eligible for because your salary is phasing out the contribution portion. If you are an S Corp, the health insurance premiums paid by the company to or on behalf of the shareholders, if you're 2% or greater shareholder, those are considered wages, which means it is an add back to your W-2. It's exempt from federal and state withholding, or I'm sorry, it's taxable for federal and state, exempt from FICA and from federal unemployment. If the S corporation shareholder is paying the full amount themselves, they get a deduction from their wages for the full amount, then there's no add back. But if maybe the company is paying the full 100% for that shareholder, then the entire 100% is going to get added back as a taxable for federal and state. So one thing, again, to keep in mind, it's non-discriminatory. So if the health insurance is only provided to a 2% or more shareholder and not allowed for the employees, they're not offering health insurance to the employees, it does not qualify as a exemption, and it's taxable for everything. And again, HSAs, partners and shareholders of S Corps are not eligible for the pre-tax. And if you're a partnership, the employer contribution is going to be treated as a distribution or guaranteed payments. Also, with 10 or more shareholders in an S corporation, you cannot have pre-tax deductions. So your FSAs, if you've got pre-tax medical insurance, pre-tax dental, pre-tax vision, the shareholders cannot get those benefits pre-tax. What you have to do in your accounting software or your payroll software is do two separate payroll items, more or less. One for your employees for pre-tax health, and then one for the 2% or more shareholders. That is going to be not pre-tax. It's going to be taxable. That's one mistake I see quite often. We're going to talk next about fringe benefits. And as you can see, there are a lot of different fringe benefits out there. And what fringe benefits are is it's just something extra that the employer gives to the employee as just, thank you for your help. We appreciate everything you do for us. And, take this bonus or leather jacket or, trip on us because you worked hard all year. Well, that is all taxable to the employee. So again, if you look at this, there are a lot of different things that are taxable to the employee as a fringe benefit. Fringe benefits are one thing that I notice a lot of employers are either not aware of or they refuse to do. That is going to get them in trouble with the IRS. So we're going to talk about a couple of the most common fringe benefits. And again, these are fringe benefits. It gets added on to the employee's paycheck, not as a wage. It's like a non-employee compensation. It should only increase the taxes of the paycheck, increase your net amount. And here's the IRS regulation. It's just saying that these are wages and can be any form: money, property, services, meals, accommodation, as well as cash. So anything that you can touch or, any kind of gift type of thing. There is a special accounting rule because otherwise it can get hard at the end of the year to combine all that information to get it on a W-2. So there is a special accounting rule that says anything provided in November and December can be put on the paycheck in the following year. One of the most common is employer-provided vehicles, which is any personal use of the vehicle is something that is a fringe benefit to the employee, subject to all taxes. And again, that fringe benefit is going to be taxable for federal, Social Security, Medicare, and state. The employees must substantiate their mileage between business and personal. There are 4 different valuation methods to figure out what the add back is. So the first one is your general valuation method. It's the cost the employee would incur to lease the same vehicle. Then there's 3 special valuation methods. Commuting rule: the employer can value the personal use of auto at $1.50 each way for commute, so $3 a day. And that's the commuting rule, and you can only use that if the vehicle is provided to the employee for company business. The employer requires the employee to use that vehicle to come and go from work. The employer has to have a written policy saying that the employee cannot use that vehicle for personal use, only for getting to and from work. And the employee cannot be a control employee. It cannot be, the director, officer, owner, with wages over 115,000, or a key employee with wages over 235,000, or owns 1% or more of the company. So there's a lot of different ifs, ands, or buts when it comes to the commuting rule. Then there is the cents per mile. And again, this is the one thing we are waiting for from the IRS to publish the standard mileage rates. You cannot use cents per mile if the vehicle is worth more than $51,100. And this amount changes every year. So keep that in mind. And it's based on the fair market value of the vehicle. So if you're not sure what the fair market value is, go to Kelley Blue Book and put in the information on that vehicle, and that's where you'll find the fair market value. Right now, the standard mileage rate is 56 cents per mile. And again, we don't know what 22 is going to be, but that cents per mile includes maintenance, insurance, and fuel. If you don't provide the fuel for the employee, you can reduce the rate by 5.5 cents per mile. And again, there's conditions that you expect the employee to regularly use that vehicle for business. At least 50% of the mileage has to be for business. And the vehicle is generally used to transport 3 or more employees to and from work in an employer-sponsored commuting pool, or the mileage test is met. So the vehicle is driven by the employees at least 10,000 miles a year for business, personal combined, and the vehicle is primary used by employees. Some more consistency requirements. So if you start using the cents per mile rule on that vehicle, you must always use the cents per mile. So if you use it 1 year, you have to use it the next year. If you replace the vehicle, say it broke down, you bought a new one for the employee, to replace that, again, you're going to use the cents per mile. The annual lease valuation, this is a chart that you have to figure out the fair market value of your vehicle the first day it's made to any employee for personal use. The fair market value is what you would put, what you would spend on it if you bought it from, Joe across the street. Again, Kelley Blue Book will give you that information. And then once you find out the fair market value, there's a table that we will show you, and also the calculation. And there is a spreadsheet that is included in the information that you would have got. So it makes this whole calculation easier. Any use of that company-provided vehicle that isn't substantiated as business use is considered income. So if your employee is not tracking their business versus personal mileage for that vehicle, it's all the mileage they put on it is going to be included in their income. So it is very important that the employee keeps a log on where they're going for business and what they're using it for personal use. Again, some requirements. You've got to use this lease valuation on the first day that the vehicle is available to the employees. You must use this rule in all later years that same vehicle is available to the employees. And again, you must use it if you replace the vehicle. Publication 15B, again, we looked at the menu before of all the different fringes, has a lot of that information in it. And here is the IRS annual lease table. And it looks kind of intimidating, but once you have the fair market value of your vehicle, it's really easy to find the number, the annual lease value, and then put it in the table. So here's my personal use of vehicle calculation. Anything kind of grayed out is calculations that you don't have to worry about. So you're going to put in the cost of your vehicle, your fair market value, business and personal miles. annual lease value from the table. So if I've got a vehicle that was $15,000, so I'd come over here and look up $15,000. I've got 4350, and that's what I put in my annual lease value. Days available for use. You want to be careful if you're buying a new vehicle during the year. So in 2021, I purchased a Suburban on the 6th, so it's only available for business use for 25 days. So you want to be careful that you make sure you put in the number of days so the calculation can split it out and prorate it based on that. If you are putting this on a separate paycheck than their normal paycheck, you're going to need to gross this up, which means if you're looking at the 2017 Tundra, the personal use subtotal is $2,261. Well, let's say I forgot to put that on my last paycheck of the year. So then I'm going to issue another paycheck, but I'm going to have to gross that up because the employee's personal use is $2,261. So technically, I've got to pay them $2,449.10 in order to take out for the Social Security and Medicare taxes. And again, the calculations here, if you need it, it's only if you're grossing up. If you're including it with a regular payroll, you're just going to use a regular $2261.75. Again, be careful if that employee is close to the Social Security limit or the Medicare limit, because you don't want to over withhold. Another common one is group term life insurance. And group term life insurance is non-taxable for the first $50,000 of coverage. And what that is, we're going to look at publication 15B again. There is kind of a 10-employee rule that generally the life insurance is not group term life unless you provide it at some time during the year to at least 10 full-time employees, but there are exceptions also. So it's a general death benefit that's not included in income, the first $50,000. It provides the amount of insurance based on a formula that prevents individual selection. So it's either, you have what you have from the employer or you don't. And it's under a policy directly or indirectly that your employer carries. The amount over the $50,000 is going to be taxable income for FICA and for federal and state. It's non-taxable for unemployment. And if you hold on one second, I just need to replace my battery in my headset. Okay, and I'm back. So that obviously tells me we're getting close to break time when my battery runs low. Couple other things on group term life. You code that with code C on box 12 of your W-2. Not discriminate. Again, you can't offer it just to the management and not to the employees. You're going to prorate it if it's less than a full month of coverage. And if it's for 2% or more, S Corp shareholders, it's all taxable. It is non-taxable when the beneficiary of the policy is the company or is a charitable organization, or if the employee terminates during the year because of a disability. So in those three cases, group term life becomes non-taxable. So anything over and above $50,000 is going to be taxable. Here it gives me my calculation. And again, there is a spreadsheet. And there are additional rules if there's group term life for your spouse or dependents, or former employees. So you want to keep that in mind. There are special rules for those. Here's the table, which hasn't changed in a very long time. So this is the cost per thousand per month. So if I look at my little spreadsheet, this is for 2021. Again, you're going to see your age at the end of this year. And Tom, Jerry, Missy, and Amy, this is how old they are. They are friends of mine, but their ages are all made up. The amount of group term life, this is the total amount. And then what the calculation does in the gray areas is it calculates how many thousands of dollars over 50,000 at the cost per month subtotal, and then it multiplies it by 12. So Tom is 36 years old at the end of the year. I go down to my table, bottom, so 36 is showing me 9 cents. Put in it, the system will automatically put in the 9 cents and calculate in column A. That is the amount that you are going to gross up their wages by. Or I'm sorry, if there's premiums paid, by the employee, that's going to go in box A. So maybe your employee contributes some of it a month out of their paychecks. The entire year's worth of what they've paid is going to be in column A. And then in column B is going to be your gross up, or I'm sorry, the amount you're adding to wages. And again, if you're doing a separate paycheck for this fringe benefit, you're going to want to gross it up. So instead of paying them $83 added to a regular paycheck, you need to gross it up to $89.88. Again, you got to be careful if the employee is close to the FICA limit or if they're close to the Medicare limit, because then you have to, you can't go over those totals. Effective January 1st of 18, moving expenses are not deductible as a tax-free perk. It's an above-the-line deduction. And there is one exception for members of the armed forces. Third-party sick pay. This slide probably should not be in fringe benefits. But third-party sick pay is something that the employer offers to the employee. It can be paid for with pre-tax dollars or after-tax dollars. So when that employee gets paid, if they get injured and they're taking third-party sick pay, if they had their benefit paid for out of their paycheck with pre-tax dollars, then it is going to be taxable to that employee. If the employee paid for that benefit after tax dollars, then it's non-taxable to the employee. Third-party sick pay can get very, very confusing. You need to know how your plan works, how it's set up with that third-party sick pay vendor, because sometimes that third-party vendor is going to pay the employer portion of the Social Security taxes. Sometimes you are responsible for those taxes, and that's going to affect, if you're responsible, it's going to affect your 941s and your W-2s. And also when you're doing the calculation for that and for the employee taxable portion of it, if the employer pays part of it and the employee pays part of it, you have to prorate it that way. So it can be very confusing. The easiest way is if the third-party sick pay administrator takes care of everything, but normally you have to pay extra for that, I believe. So if that insurer, that third-party sick pay vendor, is not doing the W-2s, those benefits have to be added to the wages, similar to a fringe benefit. It's not going to increase their wages because they've already gotten that pay from that insurance company. You're going to report it as taxable income and check box 13 for third-party sick pay. Let's see. Oh, actually, you are going to include it in their income because the third-party payer is not going to put it on a W-2. My mistake. And there is also a Form 8922 third-party sick pay recap. If you do have an employee getting third-party sick pay, make sure that you are getting statements from that insurance company that is paying that employee. I remember one time we prepared all the W-2s for a company, and then a week later, they came back with a third-party sick pay statement for several of their employees. So we had to amend a bunch of stuff. It's easier to do it with the regular W-2s and stuff than going back and amending because it's, it costs extra then too. Let's see, got a question talking workers' comp for a third-party sick pay or another sick pay. This is not workers' comp sick pay. This is if you are contracting out with, say, Society Insurance has sick pay policies. If you have long-term or short-term sick pay policies that your employees could be out on, but it is not work comp. Oh, hang on a second. I paused my screen for reminding me. Okay. I'm screen sharing now. So it's just something to keep in mind if you do offer third-party sick pay. You know, if the employee pays the full premium, then, you know, again, you're going to have to be careful if it's not non-taxable or pre-tax, if coming out of their check that way, and who's going to be reporting it on the 941s and W-2s. I do have a slide that third-party sick pay, not as an agent, and liability transfer to the employer. So withholding of taxes, who's responsible, depositing, who's responsible. The majority of the ones I see is the last two, reporting the employee wages and taxes on Form 941 and then reporting them on the W-2. And again, if you are an employer and you have to report those taxes, make sure you are including them with your regular 941 deposits. Education assistance. This is going to be a fringe benefit, taxable unless you have a educational assistant program. That's a separate written document that the employer has strictly for the benefit of its employees for paying for education. The employee has to have a reasonable relationship to your business, and it has to be required as part of a degree program. Any amount over $5,250 without an EAP is considered taxable income unless the benefit is a working condition benefit. Again, you're going to want to see 15B. It can get detailed. The CARES Act did one nice thing. It allowed for the employer to make payments on the employee student loans. Those employer payments need to be made between March 27th of 2020 and 12/31 of 25, and that can be excluded from the employee's income. So that's a nice fringe that the employer can do for their employees by paying some of their student loans. And see publication 15B for all the details, because there are a lot more than I have on my slide. Business travel, meals, entertainment, gifts, and transportation. Tax treatment of these being reimbursed depends on whether the employer has a accountable or non-accountable plan. An accountable plan means that you are tracking everything. Change my slide. Okay, here we go. An accountable plan is the employer making the employee accountable for the expenses, meaning that they have to keep the receipts, turn them in, things like that. If the employer reimburses the employee like a flat rate without needing anything as to documentation, that's a non-accountable plan, and then those benefits are taxable. So accountable plan, the expense must be business related. The employee has to turn in any advances that exceed what you got. So say I'm going on a business trip and my employer gives me $100 for my hotel room, and I only spent $80 on a hotel room, so that means I have to give my employer the additional $20 back. The substantiation has to be proven within a reasonable amount of time. So you can't say, oh, by the way, here's my expense sheet from last year. That's not going to work. You don't have to pay it then. But you should have the amount of the expense written down, the time and business, place of travel, etc., the business purpose of the expense, and the business relation to the taxpayer of the person receiving the balance. So, or receiving the benefit. So if you are taking somebody out, say a client out for entertainment, and you are maybe buying a ticket to the Packer game, and you're going to talk business at the Packer game, you should have that all documented. And again, if you're getting reimbursed by your employer, and if it's a countable plan, you have to have all this substantiation. And any expenses that are lavish or extravagant are not allowed. So if I took the company jet, wouldn't that be nice if we had a company jet? But if I took the company jet to Paris for dinner with one of my clients, that is going to be a lavish and extravagant gift. Okay, so business travel, per diem allowances. If you're paying per diem allowances for your employees' travel, that is non-taxable. It's got to be substantiated as long as it does not exceed the federal per diem rates. Anything that exceeds those rates is taxable. And you can find those rates at the gsa.gov website I've got listed. The per diem rate is a combination of federal lodging expense rate and meals and incidental expenses. These rates change based on where you are. So your per diem, if you're in Las Vegas, is going to be way different than a per diem if you're in Green Bay, Wisconsin. It depends on the city you're in. Incidental expenses, those are considered, maybe you have to use a hotel's laundry service or something like that. That would be an incidental expense. So that would be covered in your per diem for that city that you're in. Mileage reimbursements non-taxable up to the federal standard mileage rate. And we looked at that before. It's 20 or 56 cents for 2021, and 2022 we don't know yet. But say an employer gives the employee 75% or 75 cents per mile. So the difference between 56 and 75 cents per mile is going to be taxable to the employee. And the employer is allowed to pay under the federal mileage rate. So some people might only get 50 cents a mile. Depends on what your employer plan is. Next is loans to employees. I suggest not doing this, but I see several businesses that I work with doing this. So if the loan is made to the employee at an interest rate below the AFR, the difference on any day of the outstanding loan are more than $10,000, then it becomes taxable. AFR can be found at this IRS website. Loans under $10,000, you don't have to impute the interest if the purpose of the loan, unless the purpose of the loan is to avoid taxes. So there's no interest on loans for relocation to a new principal place of work, and there's no interest on those advances repaid within a reasonable amount of time, which are all under $10,000. If the employee terminates, quits, and you don't get the additional money back from that employee, that money gets reported on an IRS form 1099-C, which is cancellation of debt. That's one thing to keep in mind if you do loan the employee money and he skips town, or she skips town. So then prizes and awards. Prizes and awards that are non-taxable are achievement and safety awards or length of service awards. The length of service or employee achievement, these awards have to be tangible property, not cash. If it's cash, it's going to be a fringe benefit that's going to be added to your W-2 and wages. Not tangible personal property is something that you can pick up and take with you, like a leather jacket or a statue or, glass carving. The award should be given in a meaningful presentation, whatever that may be. It's not defined, but I guess you could give it to them at lunch in front of everybody in the break room. And the award cannot be disguised as compensation. For length of service awards, it's got to be after 5 years of service, and the employee cannot receive another one in any of the prior 4 years. So it has to be like every 5 years. So the limit is $400 for awards for a non-qualified plan. So if you have a written plan that says, in every 5 years, I'm going to give my employee this type of award, it's got to be written. And there's a limit of $1,600 for awards in a calendar year. Back pay and legal awards. Back pay is if an employee sues you and you have to pay them out. It's reportable on a Form W-2, just like a normal payroll. There are other awards that are going to be reported on a 1099 miscellaneous form that are income but not wages income. I have seen and had to do payroll for an employee that had left 2 years prior, and the company had to pay back like $10,000 worth of pay. So we had to issue a paycheck for that employee 2 years after the fact that they were gone. Jury duty pay, if your employer pays you for the full day of jury duty pay, that's fine, but it's regular pay. If your employer requires the employee to turn in the jury pay, the difference between the jury pay and the amount that the employee was paid for the day is taxable. Tips, if you're in a restaurant situation or a bar situation, tips are taxable income. We're not talking about allocated tips, just regular tips. Earnings of $20 or more a month must be reported by the employee to the employer by the 10th of the next month. There's a form actually that the IRS has, a 4070, which I've got a sample of on this page. Or you can use something similar. Maybe it's just a handwritten piece of paper. There are things that are not considered tips, but are considered wages. And those are charges that a restaurant might have on their menu saying parties of 10 or more are going to be, there's a certain fee that they have to pay extra. So that is going to be considered wages, not tips. And again, some examples are the large dining party, banquet fees, cruise ship package fees, bottle service charges, or hotel room service charges. As long as they're stated that they're a separate charge, those are considered wages, not tips. Gift cards are always taxable. They have a specific value, not unreasonably or administratively impractical to account for. They are always taxable. Whether it's $5, you have to add it back to their payroll as a fringe benefit. It's a lot of employers like to give gift cards thinking that they're not taxable, but they are. So just keep that in mind. And if your employer provides a cell phone, that's fine as long as it's not going to be taxable, as long as the employer is going to need to contact the employee for work-related emergencies, that the employer requires the employee to be able to speak with clients or customers when the employee is away from the office, and the employee might need to speak with clients located in other time zones outside of the employee's normal day. So that's when an employer-provided cell phone is not considered a fringe benefit. employer-provided cell phones used to be considered listed property, which went away a few years ago, which was a really nice thing. So adding fringe benefits to your employees' payroll. If they're entered on a regular payroll, taxes are calculated, so it may not be necessarily to gross it up. Federal and state income tax withholding is not required on the fringe benefit part of the payroll. If it is a separate check, you need to gross it up for Social Security and Medicare. And again, here's the calculation for the gross up. We also saw that on the personal use of auto spreadsheet. It's just dividing the total rate divided by 92.35%. And if the Social Security, if you're over the limit, then there's a separate calculation for the gross up because of the additional Medicare. Again, your fringe benefits should be taxable for federal, state, Medicare, Social Security. You don't necessarily need to withhold federal, but you can. You should list it in box 14 of the employee's W-2. If you don't, you should give them a separate sheet that's going to list what those fringe benefits are. There are also Minimis fringe benefits, which means these are things that the employer can provide that have so little value that accounting for it would be unreasonably or administratively impracticable. So gift cards, again, that's going to be taxable. Things like that, cash equivalents, no matter how small, are always going to be taxable as a fringe benefit. But if it is de minimis, like flowers giving to an employee for an illness, or let's say brought in donuts, just something that is not frequent, you don't do it constantly, and it is going to be a very small amount. Bonuses and awards, again, those are taxable fringe benefits and has to be included in the wages at fair market value of those services. One of my clients used to give a trip away every year. You know, here's a free voucher, go wherever you want. Well, that got, put back on that employee's W-2 and taxed on it. Some examples of some fringe benefits are using the employer's copy machine. Occasional parties, group meals, picnics, Christmas parties. You don't want to discriminate on those, though. If you're having parties, it can't just be for management. It has to be for your whole staff. Like a birthday party or holiday gifts of property, not cash, with a very low fair market value. So if I were to give away like a little holiday tree that stands 6 inches tall that you could place on your desk, that's going to be something de minimis. Or like a birthday cake for an employee. Occasional theater or sporting event tickets. They have to be very occasional. They can't be something that the employee is expecting at a certain time each year. Coffee, donuts, soft drinks, local phone calls, flowers, fruit, books provided to the employee because of a special circumstance. So this would be, if maybe an employee's relative dies, you send flowers to the funeral. Something like that on account of a family crisis is going to be de minimis. It really wouldn't be nice to tax the employee on flowers that you sent because, maybe their grandmother died. That's just not right. Okay, so independent contractors is next. And this is kind of a big thing that the IRS likes to pick on. And not only the IRS, the unemployment agencies. So an employee is the employer controls what you do, when you do it. They supply the tools and anything else you might need to do that job, and you may get benefits like vacation, PTO, health insurance, things like that. If you're an independent contractor, you kind of do what you want to do. You state, how long your project is going to last. You can have a written contract. This is what I'm going to do. Um, you might have a contract saying that if it's not done by a certain time, then I give you a discount or something like that. You don't get reimbursed for anything unless it's stated in the contract. And then you have to pay self-employment tax, which is your own FICA. So the federal government, the IRS, has common law rules to decipher whether you are an employee or an independent contractor. So one of them that they look at is a behavioral. Does the company control what the worker is doing or how the worker does it? Financial is the business aspects of the worker's job controlled by the payer. How the worker's paid. If you're paid every 2 weeks, just like the regular employees, well, they might look at that different. If you're getting expenses reimbursed, unless it's in your contract, they might think, what's going on there? And who provides the tools and supplies? Normally, if you're an independent contractor, you supply your own. The type of relationship, are there written contracts? Do you provide insurance to that independent contractor? Well, you shouldn't. And is the relationship going to continue? And is it a key aspect of the business? Minnesota has a 5-factor test: the right to control the means and manner of performance, the mode of payment, furnishing tools, materials, control over the premises where the work was done, and the right of discharge. If Minnesota comes in and sees these are being done by an independent contractor, you're going to get your hand slapped and you're going to be told you are an employee, and then things get ugly. There are separate rules in Minnesota if you're an independent contractor in construction or in the trucking and messenger courier industries. So there's different tests depending on what you're doing. Then Wisconsin has 9 requirements: maintaining a separate business, maintain a federal ID, or have filed business or self-employment income tax, the IRS. A Social Security number for Wisconsin cannot be substituted for a federal ID number. So if you're an independent contractor and you don't have a federal ID, in Wisconsin, you technically do not meet the test of a federal ID number. So you should have a federal ID number. You can apply for those online. It's free and it's pretty easy to do. So these are some things, again, that Wisconsin has: operating under contracts, responsible for your main expenses, satisfactory completion of work. You've got to receive money because you've got a contract or a job that you're doing. You have the option, or you have the right to realize a profit or suffer a loss. Have recurring business liabilities or obligations, and you've got a relationship of business receipts to expenses, meaning that, as a business owner, if I'm an independent contractor, I have to pay for, my own insurance. I have to pay for my own health insurance or my own rent and things like that. So again, that has something to do with realizing a profit or suffering a loss. So an independent contractor, if you are hiring an independent contractor, you should have that contractor complete a Form W-9. So if you are hiring Hawkins to do your tax return for your business, it would be considered an independent contractor, and you should have us complete a Form W-9. Because at the end of the year, you should be sending out a 1099 form to us. If you do have an independent contractor that is doing work for you, you should request a copy of the certificate of insurance for workers' comp and general liability. Because if you don't have that on file, when you have your workers' comp audit each year, and they decide that, these people are independent contractors and they don't have insurance, guess who has to pay their insurance? Your rates go sky high. I had a client not familiar with this. Their rates were obnoxious. They were so high because the person that was in charge of, hiring people to do those jobs didn't know that they should have the proof of insurance. So make sure you get those. If you pay the independent contractor over $600 in a calendar year, you've got to give them a 1099 miscellaneous or 1099 NEC. If you don't, you could suffer penalties. It's a good practice to get this information from all vendors. Most people will give it to the vendor immediately, and if they don't get it back by the time it comes to pay that vendor, then the person hiring the vendor needs to withhold 24% as backup withholding. So you need to require those vendors to get you that federal ID number or Social Security back, which is on the Form W-9 right here. And if they don't give this back to you, you're supposed to withhold money from their payment. There are some federal relief provisions. And if you know you've misclassified an employee or an independent contractor that should have been an employee, you can come forward to the IRS and say, I was wrong, I did it wrong. And then you'll still be responsible for employment taxes, but not to the point of if they came in and found that the independent contractor was an employee or was an employee. So the 1099 miscellaneous form, it's business to business or business to person. It's not personal payments to a business. So if I have Hawkins Ash do my personal tax return, I don't, as an individual, I don't send them a 1099. If I, as a business, had Hawkins Ash do my tax return, then as a business, I would send them a 1099 if I paid them $600 or more. So here's some of the criteria for sending the 1099 miscellaneous for rents. So if you rent your office space, the rent that you pay to your landlord is going to require a 1099 miscellaneous. Royalties, $10 or more royalties. Other income, federal tax withheld, fishing boat proceeds, direct sales, just a lot of things that are different. But the one thing that happens a lot is gross proceeds to attorney. I get a lot of questions on that. And for the miscellaneous, 1099 miscellaneous form is going to be as if you paid the attorney for like a settlement agreement. Or if maybe you won something at a church picnic. Say I went to a church picnic and I won a four-wheeler. If the winner's chosen without action, just put their name in a raffle, that four-wheeler is going to be taxable income for that winner on a 1099 miscellaneous form. Here's your 1099 miscellaneous form. 1099 NEC, non-employee compensation, was new last year. And this took the place of, I believe it was box 7 of the old 1099 miscellaneous. So these are payments made in the course of your business or trade to an independent contractor. So $600 or more for services performed by someone who is not your employee, including parts and materials. So if you get your company vehicle fixed by, Joe's Auto Shop down the road, and it costs $1,200, at the end of the year, you should be giving them a 1099 NEC form for that full amount of the invoice. And payments to an attorney. Now, these payments that go on an NW or a 1099 NEC are, let's see here, expenses incurred in the course of your trade or business. So it's more or less their legal fees, not a settlement, but their normal legal fees. Payments to corporations. Normally, corporations do not get 1099, but they do if they are attorneys. The IRS wants all the money they can get from attorneys. So it includes your law firms, any fees over $600. Payments made by a federal executive agency, which is somebody that has a federal contract. And cash payments for the purchase of fish for resale. Here's your NEC form. Now we're going to talk about the Affordable Care Act. This is still in use, which means if you're an ALE, applicable large employer, means you have 50 or more full or part-time employees, their full-time or full-time equivalents in the previous year. You should be providing them minimum essential health coverage during the year. And while doing that, you have to file 1095 forms. This is something that if you do have 50 or more full-time or full-time equivalent employees, you really need to take a look at. I just had a client that I think it was a mix-up with the IRS because it was a business sold. In the meanwhile, they got a notice that they did not provide 1095s, and they got penalized $86,130. Well, we're in the process right now of working with the IRS to get that taken care of, but because there was a sale going on, and there were a combination of common ownership within that sale, I'm thinking that's how the government got mixed up. But you want to definitely file those 1095s if you have 50 or more employees. You don't have to have health insurance, but you have to report that you don't. So again, large employers who offer affordable health care, and then employers who fail to provide get stiff financial penalties, as my client has found out. But again, sometimes you can get out of that. I had another client that got a penalty for that, and we were able to abate that by proving that they did not have 50 or more full-time employees. And at Hawkins Ash, we do have 1095 services that works pretty slick. And some miscellaneous items. These are, for your first payroll in 22, make sure you enter your new state unemployment rate in your payroll software. And if you haven't gotten a letter by now, because normally they are issued in October or November. Nope, they're issued in October. So if you haven't gotten that, you can log into your unemployment website and find that new rate. Any changes for health insurance, HSAs, pre-tax premiums, things like that, make sure that your payroll software is updated for that. If you have any employees that claim exempt from withholding taxes, they need to fill out a new W-4, WT4 in Wisconsin, or W4MN in Minnesota. And what you normally want to do is if you do have a lot of different deductions, Section 125, 401ks, you want to manually calculate like the Social Security withholding and Medicare withholding on that first check to make sure that everything is calculating in your software correctly. Let's see, got a question, e-filing requirements for 1099 miscellaneous and NEC for 2021 forms. I know in Wisconsin the e-filing requirement is 10 or more. I'm not 100% on Minnesota. I'll get to another question in a moment. So record keeping, we do have a record retention schedule on our website. You should keep documentation for 7 years in the event of an audit, including all of your tax returns. If you scan them in, put them on a CD or a flash drive, just have that information handy in case of an audit. We do have, again, I mentioned the record retention schedule, so you can go on our website to find that. And here are our locations. We are located in Wisconsin and Minnesota, and here are our phone numbers for our Wisconsin offices and Minnesota offices. So if you do have any questions regarding any of the information that we went over today, you can call one of our offices and ask to speak with a accounting services associate. There we go. So feel free to ask questions. And let's see, I've got some questions coming in here. Let's see. Need a certificate of insurance if the vendor does not do work on your property? I believe so. We have a question on seasonal employees. If they are counted as count for the CARES Act for the large employer, and there are special instances for seasonal employees. Here, I believe I have a publication number I can give you for that. And I can't find it quickly. There is a publication out there on how to calculate the large employer for the CARES Act. I can try to get back to you on that one. And let's see, if I have a rental and pay over $600 to a repair person, do I need to file a 1099 for the rental unit? And that is yes, you do. Anybody that is doing any type of work for you, and you're paying over $600 should get a 1099. So if you're hiring somebody to cut your grass, to plow your parking lot, things like that, your attorney, your accountant, maybe you've got an engineer company that you work with or something, they should always get a 1099. Does it matter what state the independent contractor lives? No, it does not. This is a federal rule. It's federal, and it doesn't matter what state. All questions I have. Okay, I think that's about all the questions, at least right now. And oh, another question. You don't have to issue 1099 for a corp. That is correct unless it is a law firm. If a law firm is a corporation, they still get one. That is one of the only exceptions to the corporations don't get one. If they are a law firm or attorney and they are a corporation, they still get a 1099. So government and law firms must not get along very well. That they're going after them. Okay, and we've got a question on an HRA. And my husband carries family insurance through his employer, and my employer offered me an HRA. I think that is double dipping, but I am not 100% sure. That's something I would have to investigate, and I can get back to you on that. So on that note, I am going to thank you all very much for joining me today, and I hope you got a little bit out of my presentation. There's a lot of material, and I know it's not the most exciting thing in the world, but you know, obeying the laws and doing the right things are going to be a lot easier than doing the wrong thing and getting caught later. It's if you say an independent contractor that should have been an employee, if they come in and say it's an employee, not an independent contractor, you've been paying them for a year that way, it is going to cause a lot of problems because number one, you haven't been withholding FICA taxes. Number two, you've made those payments late. So you have to refile 941s, you have to refile W-2s, or file W-2s because you didn't before, and you can get penalized for late filing. It's just crazy. So that's just, do the right thing to begin with. And if you have questions, again, our phone numbers are listed, and ask for an accounting services associate, and they should be able to answer your questions. If not, they'll find somebody that can. So on that note, I appreciate your joining me today, and I hope you have a great day, a wonderful holiday season. Bye-bye.